Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I am Paul Winkler, talking money and investing. Wow. Talking a lot about just things going on in the market. I hear so many people they're just trying to tell us, hey, what's going to happen next? Where are things going to go next? And I talked a little bit about that last hour. Have a fear of the future. Want to try to predict the future? What's going to happen next? I don't know what's going to happen next, but how do we know that this person out there knows what's going to happen in the future? Well, look at their past. Did they predict it? Did they figure it out in the past? Did they predict what was going to happen and it came to fruition? If so, this person is really, really smart. If not, well, maybe we don't need to listen to them. So what we often do is that, and then we just go, gosh, everybody's telling me what's going to happen. I'm overwhelmed. I got so much information coming at me from the left and the right. I don't know what to do. So then we just go, I feel excited about markets. I feel excited about what's going to happen in the future. I'm hearing good things. And that's something I want to spend just a second on, because this is why this is so hard on investors trying to figure this stuff out. When you hear, let's say that markets are going up and stocks are rallying, things are doing well, or let's say the stock market's stinking up the place, it's doing horribly. And you hear that bonds are stable, they're strong, that interest rates are good, they're high. People are making money on, maybe just having their money in CDs or something like that. It's not just stock markets where people get attracted based on past performance. It's also bond markets. We don't think about it that way, or it's products. If you think about how insurance products are actually put together, well, how are they put together? I'm going to tell you, I have watched this for 25, 30 years in index annuities, for example. The way they put the products together so often is this. What would have done well over the past 10 years or 15 years? What strategy would have done well? Because what they're doing when they're thinking in that way is they're putting the product out based on what the sales brochure is going to look like. They're actually going to look at what strategy, whether it's following the NASDAQ, having a certain, let's say, a cap rate or a participation rate. These are all technical terms on how these products actually work. And they're basically option strategies. They're backed by option strategies. Well, what would have worked over the past 10 years? Because what they're thinking about is the sales brochure, and they'll have a little chart in there, and they'll compare the chart to an area of the market, or they'll compare it to some investment strategy. And if their little mountain chart is higher than the other investment strategy that they're comparing to, you'll go, wow, this does make sense. I ought to do this. This sounds like a really good idea. This seems prudent. I saw a video the other day, and I haven't watched it yet. I'm going to do that sometime soon, and I think it's going to be a radio segment sometime soon. But this guy was saying, I have a sales presentation, and I don't remember exactly. I want to tell you it was like 2 or 3 minutes. In 2 or 3 minutes, the client will be eating out of your hand and want to buy the annuity from you. Just watch this. And it was some kind of a little video on it. I think I saved it someplace. Hopefully I saved it someplace. Hopefully I sent myself a link to it because I thought, wow, I need to do a segment on this one. Because I know what they're going to do, because I've sat through presentations from insurance companies teaching people how to sell this stuff. They're going to play based on greed. They're going to play based on fear that you can't lose money. You'll make money. The market goes up. They're going to judge it. They're going to give you something that you're going to make a judgment based on how it did versus some other market segment, or it's going to be something like that. That is typically how they play this game. They play on your emotions. And, in this particular instance, right now what we're doing is we're seeing people come out with markets. Now, I've said we look at past performance versus, stock markets, and we go, wow, this market really, really did well. And we'll be listening to the media. And the media will have all of these segments out there talking about why the stock market went up. They'll be talking about the stock market's rocking and it's doing really well. Why? Because of, let's say, productivity growth, because of Trump's policies regarding immigration, because of the policies regarding tariffs bringing more infrastructure or manufacturing back to the United States, or because now we're going to be getting into this race. I saw an article this morning about a race that we're having with China regarding nuclear energy. That's the most recent thing. Now, if you can get nuclear energy, we can reduce expenses there. Let's say we reduce the energy expenses. That's going to be good for profitability for companies. So that's exciting. So you'll hear that there'll be something out there telling you why, or interest rates are going down. That's why, let's say that we're going to have this rally in the stock market. Interest rates went down when people didn't necessarily think they were going to go down or whatever. But recognize that the media responds and writes articles, and in concert to you seeing that article about how good things are going to be, the stock market's going up. Why? Because the market goes up in anticipation of things getting better. It's not in real time. It's not based on what's going on right now, and that's where people get really screwed up when it comes to the stock market. They think that things are going to be better in the future, and therefore the stock market will go up. Not necessarily so at all. You could have awesome things going on in the future and the stock market come crumbling down. You can have terrible things happening and the stock market could be going up. It is relative to what we expected that is key. If I think on a scale of 1 to 10, that the economy is going to be a 9 going forward, and it comes in at an 8.9, which is not bad, stock markets go down. We expected a 9. When it came in a little bit less than that, then you'll see stocks go down. Or if I think things are going to be terrible, I think it's going to, on a scale 1 to 10, I think it's going to be a 4. It's going to be terrible. But it comes in stink plus, as I like to say. It comes in at a 4.2. Stock markets go up. Why? Because we expected a 4. 4.2 is an improvement. And that's the way markets work. Now, if we hear, let's say, that the economy is awful, what will you hear the investment industry talking incessantly about? Fixed income, bonds, cash investments, high yield savings accounts, high yield bonds. And that's what you're hearing some of that because our yield spreads are so thin right now. What's a yield spread? Well, if the government borrows money at 4% and a high risk company is borrowing your money at 6%, that's a pretty narrow yield spread. There's not much of an additional return that you're getting lending your money to a company that is in bad shape. That is important because that's what's going on right now. Now, the question is, are we due for another financial bubble? That's the question that people ask themselves. Because we think, what are we in a bubble? Is it going to come crumbling down? And I often am quick to point out that if you look at a lot of different areas of the market right now, we're not looking at bubble territory in a lot of different market segments. As a matter of fact, it's kind of, just pretty humdrum in many areas around the world. You have companies selling for 4 or 5 times book value here in the United States when they'll be selling for a fraction of maybe even 1 in some market segments around the world right now. So it's not at all. But remember, this is being written to an audience that invests mainly in big U.S. companies, American investors. So the Wall Street Journal says, are we due for another bubble? And I thought, it's just interesting stuff in here. So let me just walk you through some of this stuff. And it's just my thoughts on some of it. Bubbles loom large in our historical understanding of financial markets. And, I did was it a video? I'm trying to remember. It was a commercial. I can't remember. The other day I was talking about how much what we are going through right now just reminds me so much of the late 90s. And I was talking to Michael in the office in Goodlettsville about this. I said, gosh, is Michael and Chad Harrington, he's a guy that does a lot of book work with us. And he and we got in conversation, and he said, so what's going on, Paul? And I said, it just reminds me a lot of the late 90s. He said, how so? And I said, well, I remember watching CNBC, the financial channels, and I'd be watching it, and people are all excited about the stock market. They're all just fired up about, and mainly fired up about one area of the stock market, and it was big U.S. companies. And back at that time, I had been studying under Fama and French and Rick Sinquefield and all these different academics who were just monsters in the world of research on markets. And they were talking about how people are just not diversified as much as they should be. And they're talking about areas that you ought to be diversified in. And I thought, well, I took it to heart. It made sense to me. But I'm watching TV and I'm listening to the talking heads and I'm going, they're talking about anything but that. I mean, it's just the opposite. So I'm listening to this stuff and I started the radio show in 2001. And when I started the show, it was like trying to get people to listen to what I had to say was really, really hard. And it was that bulletproof nature of, things are, there's more. I was doing workshops back in the late 90s. I was teaching workshops all around town. And, anybody that would listen to me. And it was so hard getting anybody to act on what I was teaching. It was just like, I know, Paul, yeah, sounds great. I'm doing well. I remember one guy coming up to me after a workshop. It was to a civic organization I was talking, and he goes, what do you think about hedge funds, Paul? And I'm just going, oh, gosh, not much. But, to explain it to him, I went through a cogent explanation on why it was a really bad idea. It did not matter how logical my explanation was. He was going to do the same doggone thing anyway. I remember going out and people would invite me to go speak at investment, these clubs. And I would say, what you guys are doing isn't prudent. It doesn't make any sense. This is nonsense. Don't do this. They wouldn't listen. They would not listen. And it was so hard to get people to act. Well, 2001 rolls around. We had a bad year. 2000 was, S&P was down 9. Wasn't the end of the world by any stretch of the imagination, but it wasn't great. But still, people were like, it's the markets go up and they go down. You still couldn't get people to listen. 2001, you get to the end of the year, you're down another 12% for the S&P 500. And mind you, your value stocks were up 10% in 2000. So you definitely didn't have everybody necessarily, if they had any diversification whatsoever, they still weren't necessarily listening. 2002, S&P down 22%. And then you have value, it was down. And then, some people are going, whoa, wait a minute, maybe we ought to start to listen a little bit. And the radio show's gaining popularity. And, things are, more people are calling up and say, hey, what do you think I ought to be doing with my stuff? But I was getting people calling the radio show, they say, I lost this much money in the NASDAQ. I lost this much money in the S&P 500. Oh, my goodness, Paul, I had this stock. What do you think I ought to do? And I go, well, when's the best time to be prudent? And they go, well, whenever you figure out what prudent is. Well, right now. And I said, good, go do the right thing right now. And they still wouldn't listen. And then, it was just like, I've just lost too much money. I lost too much money. I can't do anything right now. And I'd be shaking my head going, oh, my goodness. If you had texting, I'd be SMH all over the place, shaking my head. I'd be all over the place. But texting wasn't a thing back then. But I'd be shaking my head, go, oh my goodness, how do I get these people to listen? And the answer was you don't. 2003 rolls around. S&P 500 up 28%, but you have small caps up like 74%. Still could not get people to listen. Because the recovery wasn't long enough for people to go, well, this is real. This is what's going on. Yeah, this is, it's real. 2004, another rally. Markets around the world. All of a sudden, people start listening because it becomes real. 2005 up, people are really listening now. 2006, people are like really locked in to my message. They're really listening. Now, I'm talking diversification, and I'm making sure people are really super, super well diversified. But it was funny because if they were really listening, the time I really wish they were listening was before the recovery started happening. And it was because they wouldn't have lost as much during the 2000 to 2002 because people are reeling from, the NASDAQ being down 80%. They're reeling from it. And then when recovery happened, and I said this during 2001, 2002, I was saying that, the thing that went down so much is the tech stocks went down so much. But I said, mark my words, they will not necessarily be the thing that comes back the fastest. Because what made them go down is new information that told us that we were overpaying, that they were overbought, that the prices were too high. And lo and behold, that's exactly what happened. NASDAQ did not come back nearly as fast as some other market segments, international particularly. And NASDAQ wouldn't be an international market. So that's basically what happened, and it was hard to get people to listen. And this is really why I think it's so important, because we're seeing some things that are looking a little bit, I say history doesn't repeat, but it rhymes. And we're seeing some things. And let me do this. I'm going to continue with this particular article after a break because I want to spend a little bit of time on it because there has some really interesting stuff about historical market crashes that I think you'll want to hear. Fascinating stuff. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out because I think you're going to really like it. paulwinkler.com/relax. All right, back here on the Investor Coaching Show, Paul Winkler, talking money and investing. So, the question is, are we due for another bubble? What is history teaching about market crashes throughout history? We got a lot of data. We have data going, Wharton, they're quoting one here. It's probably the Wharton Business School because that's the only data source that I know that goes back to 1790. It has to be Wharton that they're quoting here. But anyway, it says, bubbles loom large in our historical understanding of financial markets. So a bubble, the market goes up, and pop, right? They're memorable, they're colorful, they're scary. They raise questions about investor psychology and madness of crowds. In good times, we worry if we're going to be caught in the next bubble. Remember I said earlier, fear of the future. Looking at financial bubbles since 1790, however, we find that they're much rarer, in this article they're saying, than their presence in the public imagination. And of course, we think about it. This isn't unlike anything else. I mean, think about news now. We hear about people being killed. We hear about people, getting in auto accidents. We hear about plane crashes. We hear about things that are relatively rare in the scheme of things. It used to be that we lived our entire life and you heard nothing that happened outside of 15 square miles of your residence. I mean, that's kind of the way it worked, right? And now you hear everything going on everywhere, all over the world. And so it seems like the world is way more dangerous right now than it's ever been as a result of that. That's just natural, right? Well, the same thing with stock markets. We hear about that kind of stuff because the type of thing that gets your attention is something scary so that maybe you can protect yourself against it. It's the nature of trauma. It's kind of like, scary stuff. I've got to protect myself against that. And we got to somehow make sure that we don't end up being hurt in some way. So we pay a lot of attention to things that are potential harmful things. I mean, that's just the whole deal, right? Looking at financial bubbles, since 1790, however, we find that they're much rarer than their presence in the public imagination and not necessarily negative. They set the stage for major changes in people's worldviews. And I think that's very, very true right there. Let me rest on that for a second, because I remember back in 2000, I guess it was 2008, I did this video. I remember where I was doing this video, as a matter of fact. The markets were like really rough. It's either late 2008 or early 2009. And I remember sitting in my little office in my house doing a video, because I was doing videos all the time to keep people from doing stupid stuff with their investment portfolios. That's when I started doing videos. I started doing my videos back in 2007, 2008. And I remember sitting there behind my desk, and it was just a terrible, terrible time in the stock market. Just big, big declines. And I said, folks, let me just speak some wisdom into this. If you look at what's going on in markets right now, it's scary. Granted, it's scary. Bernie Madoff was making the news at this point in time too, right? The big Ponzi scheme guy. And I want you to think that you may be looking at it going, stocks are down and it's never going to recover. There was one guy that was actually he was going on financial shows. And I remember he was on with Maria Bartiromo. Maria, it's never gonna recover. He was like, he had this wicked accent. It's never gonna recover. It's gonna keep running. He was so dismal. Oh my goodness. So, the point that I made was this. I said, look around your house. And I'm sitting in this office and I'm going, you may have a computer nearby. You may be watching this on a computer. You may be sitting in an office like I am with tiled floors. You may be sitting in a living room with carpeting on the floors. I said, might have a bookcase like I have behind me. You may, like, let's say out in your driveway, you might have a car. And I'm just naming all this stuff around your house. And I said, I'm going to bet you that you are not going to make, let's say that you need to replace tile in your house at some point. You're not going to make the tile yourself. You're not going to build your own car. You're not going to make, and I'm pointing back in the bookcase, you're not going to make your own bookcase. You're not going to, some people are out there, you're handy, you do that, but you're not going to do this stuff yourself. You're not going to make your own computer, I'm guessing. Now, you're not going to make your own computer chips. The reality of it is we rely on other people to make these things. And the reality is you're probably not qualified to make any of this stuff. So at some point, you may, and I remember using this analogy, I said, you may repair your car and repair your car and repair your car until you can't repair your car anymore. And then at some point, but you're going to still go to an auto repair or an auto, let's say a parts distributor to buy the parts. And if something breaks, you may not replace your car right away, but at some point you're going to want to replace your car. And it wasn't, it was 2 years later, something like that. Remember Cars for Clunkers? Remember that program? They basically had a program, Cash for Clunkers. I just remembered it. It was Cash for Clunkers. Remember they had a program to buy your old used car off of you. And, and people went out and there was a huge run on new cars. And indeed it happened. And stock markets went up like crazy. So what happens is that you have these negatives and they're not necessarily all negative. The markets going down aren't all negative like they're saying in this article. And I said, and I remember using this part of it as well. I said, you go to, let's say, auto manufacturing plants. And I said, when times are good, what do people do? They go, a part drops off the conveyor belt and they kick it out of the way because it's more of a waste of time to go pick it up than it is to just kick it out of the way for the time being. Now, when things are bad, you're all about efficiency. You do everything you can to save money when things are bad, and then that's when companies get real efficient. Maybe they have employees that are kind of dead wood. They're not necessarily increasing productivity a whole lot. They lay off the people that aren't so great, and they keep the people that are really good. And that happened too. The same exact thing happened. The unemployment rate went way up. You may remember 2009, 2010, you had big unemployment. Because remember, the stock market recovered, but the economy hadn't recovered. So what happens is that people do tend to fix things when the economy is bad. And, this starts to change things out there. Well, it says, in this person writing this article in the Wall Street Journal says, in my research on more than a century of global stock market returns, I looked for how often bubbles occur. I define them as rapid doubling of stock prices followed by a crash that gave back all or more of the gains over the next 1 year or next 5 years. Now, I'm going to just make a point that definition isn't, that's their definition. And you may actually be thinking, hey, what if the market just goes down? That's a bubble bursting as far as I'm concerned. I may not give up all my returns, but giving up 20% of my returns is bad enough. But, so their definition is a little bit narrow here, granted. But it says, looking back at all the possible 5-year periods, bubbles only happen in less than 0.5% of them. And it says that the research that I've done with Schiller and Kim, two academics, we conducted monthly surveys of U.S. investors for the past 25 years asking about potential market crashes. Typically, they put the odds of a catastrophic crash in the next 6 months at 10 to 20%, which is much greater than history suggests. And, I would agree in general, though, that is the case. But, you look back at markets and you say, well, what downturns have we had historically? And you have the 1929 that everybody remembers. You had the S&P 500 went down about 8%. Next year it went down 25%. Another 43% the year after that, 8% the year after that. You didn't have another real downturn in 1937, which was not that far afterward, but you had a 35% decline that year. And then 1940 it was about 10%. 1941, we're getting into World War II, about 11%, 12% downturn. You didn't have another downturn until 1946. We came out of World War II because during World War II, the markets were, S&P 500 anyway, rocking and rolling. Well, all markets really were during World War II. And then you had a decline after we got out of the war. Why was there a decline after we got out of the war? It was 8%. It wasn't huge. But it was a decline because factories had to go from producing war machines to producing cars and trying to figure out how to get people to want to buy stuff again. Then you didn't really have a major downturn. In 57, you had about a 10% downturn. In 1957, 1966, there was another 10% downturn. 73, 74, that was major, about a 40% decline between those 2 years. So you look back and you go, okay, so you have 1930s, mid-1970s for a big downturn. 2000, you had the 40% decline. But remember, I said that, from 2000 to 2002, even though the S&P went down 40%, there were other market segments that didn't go down much at all, like value stocks and international companies, small value. It wasn't bad at all. It was actually fairly decent during that period of time. And then 2008, you had that downturn. So the point made is that we do. And then you look at the increases in value after those market downturns. If you look at 1933, when the market went down so much during the Depression, you had a 54% increase in the S&P 500 in 1933. Yeah. Go ahead, Leviticus. Oh, you're in my ear. Oh, you're asking me a question in my ear. Okay, all right. How do I know if you're not in my ear? It reminds me of Rush Limbaugh. He used to have Snerdley. I would talk in his ear, and you go, "Is Snerdley on air?" I don't ever hear Snerdley. A lot of people don't even remember who that is. Yeah, okay. So go a little slower on that. Okay. So the point being is that when we come out of these declines, like the 73, 74 decline, we had a 37% increase in 1975. 1976, a 24% increase in the S&P 500. So yes, the markets went down, but they came back so rapidly that anybody that got scared in any of these downturns did themselves a huge disservice. The 2008 downturn, well, you look at 2009, it was up 26%. 2010, up another 15%. And you had other markets that were up even more than that. And that is what I think is key when we look at bubbles. We get scared about them. A, you can't predict them. B, they don't happen that often. But C, when markets come back, they come back so fast that you can't get back in on time when they do go down. So it's pointless to sit here and get worried about this stuff. What should we do as investors? Yeah, we sure should be more diversified than most people are right now. But recognize that even getting pulled in by stories like this, talking about when the next bubble is going to happen, what's going to happen, how frequently they happen, it is a huge waste of time. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.